Everyone, I'm here to tell you today, shorting stock is for losers. Why put buying is for winners out there. Let's talk about the markets. The Fed comes out, they cut rates. They cut rates, but the S&P 500, it doesn't like it. It's declining. Volatility starts to soar. Then the next day, you have new tariffs on China. The stock market tanks again. Volatility is soaring. So how do we take advantage of rising volatility, declining equity prices without shorting stock? Because when you do short stock, well, you're on the hook if the company announces a takeover. What if that stock that you shorted, that company, over the weekend, they announced, yeah, we got bought out, 50% premium. Now you're left paying that premium. You're on the hook for that. Your account is going to hate you. They could have unexpected positive news, sending the share prices higher. Well, you can't plan for unexpected news, can you? But when you're short stock, you'll feel the pain. A well-known activist, an investor could come in, announce they just took a stake in the company. Like Carl Icahn, for example, taking a stake in Caesars. Now Caesars, 30% premium out there. That causes the share price of the stock to soar. You could just be overall the sector. Let's say you go and you shorted Apple. But yet Facebook and Microsoft and Salesforce and all these other tech stocks, well, they start rallying. You have the overall sector risk associated with the short stock. And let's not forget borrowing costs. Everyone wanted to short Beyond Meat, but the borrowing costs were so expensive that the brokers are going to make you pay every day that you borrow stock to short out there. And some of the borrowing costs, they add up. I know from experience. And then the worst, and I've been on the side of this, a short squeeze. You blow out your account, you get margin called. Have you ever been there? And here you are short stock, and that stock that you shorted, you thought it was we'll say it, a POS. It continues to move higher, and it won't go down. And all you do is see green candles, and you're thinking, hey, let me short more. It's got to go down, and it doesn't. You're left on the wrong side of a short squeeze. It's one of the worst feelings ever. So let's look at the S&P 500. This is the SPY, the ETF. And you can see over the past 3 days, well, it's starting to tank. It's falling. And down below, this little line chart, this is implied volatility. So as stock prices go lower, volatility rises. Now, why is that important when you're buying puts? Well, when you buy puts, you're limited to the initial premium you pay for the put options. So let's say you go buy the December, we'll call it the 250 puts for $1. You can only lose that $1. So you buy one contract, that's $100. $1, one contract at $1, that's $100. That's the most you can lose out there. As the stock prices move lower, so let's say you short the S&P 500, and every time it goes lower, and let's say you bought puts, volatility rises, meaning the put prices go up in value. When volatility rises, the prices of options rises as well. So when the S&P 500 moves lower, volatility rises, you make money not only on the declining share price, but also on the rise of implied volatility. It's a double whammy, and it's used to amplify profits out there. And then one thing I know from a professional trader, and all the professional traders, investors out there, they use options because you can have the higher percentage returns rather than shorting stock or by playing the stock itself. For example, if the S&P 500 falls 10% over the next 90 days, well, if you short stock, you're going to make 10%. That's it. But if you buy put options, you can possibly make 100%, 200%, or even 500% return depending on the date and the strike price that you buy. So these are some examples of how you can take advantage to falling stock prices and rising volatility in today's market by buying puts instead of shorting stock.